Okay.
Good morning, everybody. We let people pile in here for a few minutes. In the meantime, we'll frolic and have some fun, and Sean will give us a countdown when we're ready to go. Got the world's famous Dory Wiley today. Can you believe that guy doesn't look one day older than when he, what, 40 years ago, I guess we were hanging out. So, yeah, some guys do it and some guys don't.
Clean living, right, Dory?
That's right.
I believe that.
Just don't do any due diligence on that.
Don't worry, we don't have any investigators that are going to start prying into your past.
All right.
They've probably already done that with all of us. Escaped again.
Yeah, I'm on some kind of wanted list, I'm sure.
How are we looking on
Yeah.
time, Sean?
We got about 2 minutes. We'll give it about another minute and then we kind of get rolling, let some more people come in.
I think we'd start early and just piss everybody off.
That's
If
right.
we're
Yeah.
here on time, that's just the
That's
way it
it.
goes.
Yeah. If you're on time, you're late.
Right. So if I recall last year about this time, you guys had masks and horse heads and all these costume things. And I was watching the inside of the numbers and I saw that and nobody told me. And I was completely unprepared. And you turned around with that horse head on. I'm like, what in the hell is he doing?
Yeah.
Yeah.
No. Yeah, it's been a while since I've been fired, so yeah.
Dave, what's the weather like down your way? What's the high today?
Man, I'm telling you, it's fantastic. It is really nice. Yeah, I can't remember the last time I got chilly. So yeah, it was kind of nice. Got outside this morning, it's like cold breeze and ooh man. That was fall. Tomorrow will be wintertime and a snowstorm or something. But yeah.
I think we're not going to get out of the 60s today, which is okay by me. This is my favorite time of the year, and I think it is for a lot of people.
All right, guys, we're at 10 o'clock. You want to kick it off and get rolling?
Sounds great. Welcome everybody. Man, have we got a big show today. This is pretty cool stuff for me. Dory Wiley. Man, guy's a legend. And one of the sharpest people I know. I mean, just say that. We're going to try to do things a little bit different today. We're going to do a little speed dating on the numbers so we can get through that stuff and encourage everybody to type in questions for Dory. Dory's going to just go like a bat out of hell and have a great time teaching us and showing us his insights on everything. And you never know if we're going to debate or agree or disagree, but it's going to be a lot of fun. So I'm looking forward to it. One thing I want to say, if everybody can see the little sponsor quilts, these are huge, y'all. I want to just point this one thing out that I don't know if I've ever really mentioned this. There's a lot of cores that are all doing the same thing. And I'll tell you what, the last time, it's kind of like the North and the South in the 1860s. They're just not really friendly with each other a whole lot. And to see everybody get behind something is really nice. And the fact that it's inside the numbers, bankers helping bankers, that's just great stuff. And we're really honored to have all of that and all of the sponsorships so we can help you guys out.
Dave, just to echo on your remarks, I think it'd be fair to say we wouldn't even be here today without all of these sponsors. And you're right, for them to get behind something that they feel is important that helps community banks, we're forever indebted to them for their support.
Yep, indeed.
Well, kick us off, Sean. Cover some economic update.
Well, yeah, Rick, if you wanted to skip them one ahead here. And first, I want to introduce and actually thank our special guest, Mr. Dory Wiley, President, CEO, and I believe co-founder. Isn't that correct? Of Commerce Street.
Correct.
Yeah, and not much for job hopping. You've been there pushing 20 years, right? At least a little over 18. So that's fantastic. Um, Dory, got your got your undergrad from Texas Tech, Rawls School of Business. Yeah. And then get your MBA from SMU Cox School of Business. So and I think, do you have your CPA license?
Yeah, I have low self-esteem. CPA, CFA, CVA, RIA, all kinds of
MI,
stuff.
MIA, yeah,
I'm in
all
the
of it.
continuing ed business, really.
There you go. There you go. Yeah. Well, we are delighted to have you. And again, we want you to jump in, interject at any point on anything that you want to talk about. So go ahead and roll us forward, Rick. So a little bit on the economic side, the first part of our presentation, we did have an FOMC meeting yesterday with a 25 basis point rate cut. We're going to talk about kind of a comparative and historical look at loan delinquencies. Oftentimes you'll hear kind of the sky is falling from the media, and we want to kind of dispel a little bit of that. And then we want to look at some of the bank performance and some of the equity performance out there, and particularly as it leads into M&A and some yield curve analysis. So let's go ahead and kick us off, Rick. All right. So, like I said yesterday, we had a 25 basis point rate cut. I think that was pretty much baked in. Everybody saw that coming. If you look at this graph, the heavy purple line, I've got that at 4.0 because I look at this as kind of like what the Fed discount window pricing is. And if you kind of cover one eye and squint a little bit, you can kind of see on the right hand side of this graph where your inflationary data is actually trending down. Kind of like, again, if you squint real hard, and then you've got your rate structure coming down as well. And I kind of liken this back to um, really the soft landing analysis. And I really kind of make that as synonymous with a potential glide slope. And again, if you look at that, you can kind of see that that's kind of coming in soft and easy, and it's probably taking a lot longer than what everybody wants, but it's probably a lot better than, heading into second base full speed, sliding and dirt and gravel and rocks flying everywhere.
Dory,
So this is
any thoughts on your part, Dory?
Well, I just snapped the screen. I like that graph. We've come from pretty big good spike in inflation. It's getting stuck at 3%. I think the real divide right now is: are we more worried about inflation, or are we more worried about unemployment? And traditionally, Fed and economists and the like, is you're always more worried about inflation than you are unemployment. But the rhetoric has sort of switched as of late, so that concerns me. That hey, we're okay with 3% inflation. We're going to worry more about unemployment. Whereas I think I'd be more worried about 3 spiking to 4 and lowering rates too fast. I don't care if unemployment moves up to 5, 6, or 7 or 8%. It's inflation that bothers me. We've got a demographics out there where we're getting less and less workers. In addition, we're pushing, illegals out, and so some of that will be cured purely by demographic demand. That can be fixed, and once the inflation genie's out of the bottle, you can't fix that. You can ask Venezuela.
Yeah, they'll definitely take some pain. Yeah, go ahead and kick us forward, Rick. Now, from the consumer perspective, the consumer, if you look at wage growth, is still outpacing inflation. But again, we're starting to kind of trend down, and I think that's one of the reasons why the FOMC is kind of looking at this. You've got a light labor participation rate, you've got uh, nominal wage increases outpacing CPI, and you've got a very, very low amount of jobs added. Well, at least what we were able to see while we were getting government data. So,
I got a
and
question.
one thing they actually did key in on was a lot of announcements on large corporate layoffs that have been announced in the last 30 to 60 days. So
All
go
right.
ahead and kick us forward one, Rick.
Hey, real quick before we move forward there, Dory, uh, one question I've got when we talk about labor participation, you mentioned, illegal, undocumented, however you want to, phrase that. With that, let's just say influx over the last several years, and now that's shut to zero, and in a lot of cases heading back the other direction. Is that have an impact on labor participation rate?
Yeah, I think it will. I think it might increase. Of course, part of the problem is, can we trust the data and what's being
Right.
reported on illegals and what isn't? And if you visited with various Fed officials, which I have, they don't trust the data. So my little smart aleck remark about not having data from the government for this month and maybe next month is, well, heck, they didn't trust it anyway. So how blind they've been flying blind for a while. So yeah, that would be my concern about, or at least hesitancy on the illegal situation. How much of that data, how much of those numbers were in the data to begin with?
Right.
Yeah.
Thank you.
Yeah. So this was just a quick peek at the third estimate. The final estimate of second quarter GDP was revised up from 3 to 3.8. There's obviously some swings in there from Liberation Day, as inventories and exports, and we'll talk about this a little bit more. But go ahead and kick us forward one, Rick. And so if we look at the difference between the first estimate versus the third estimate on second quarter GDP, now we were supposed to have a third quarter GDP number out, but there we go. We don't have one. But really, the big part is that the consumer remains strong and continued revisions up on consumer spending. And again, I think that really points back to job growth, unemployment, the health of the consumer, wage growth in excess of CPI. So I think we're really kind of floating a tight line there where everything seems to be fine until it isn't. And that seems to be some of the big kicker. I really love the real final sales to private domestic purchasers number. Came in at 2.9%. I kind of look at that as almost like core GDP of what is really happening in the U.S. from a consumption standpoint, and that's that was up from 2.7 in fourth quarter and up from 1.9 in the first quarter. So again, the strength of the consumer seems to be driving the economy at this point. So go ahead and move me up one, Phil, unless somebody's got some
Before
comments
we
here.
leave that, Sean, I would just, Dory, from your perspective, obviously there's been a lot of conversation about tariffs and what their impact will be more in the longer term. And I'm just curious, based on the people that you speak with in your own research, any thoughts on the subject that you'd like to share?
Well, the first hit to the market was on, I guess March or April, when the market went way down, and oh my God, we're going to have tariffs at the end of the world. It's like Smoot-Hawley, right? Smoot-Hawley is the reference points. That means we're going into a Great Depression. So the market sells off. And, that's not necessarily the case. Trump started tariffs in his first administration, market sold off, and then 6 months he had it all worked out. It's been slower this time, right? But the market's having a hard time figuring it out because the market sees tariffs as a black and white issue, not as a negotiation issue, which is what it is for Trump. So one day it's 100% tariffs for China, and then the next day he's a good guy. He likes him. I like him. He likes me. He's a good guy. We're going to work this out. So I think it's all part of the negotiation, and it's not going to be long term. But to the extent it'd be a one-time hit. I think the bigger issue really right now that the market might want to focus on is the government shutdown. It's gone for a pretty long time. The CBO estimates about a 1 to 2% Q4 hit, which is about 7 to 14 billion lost in GDP. But that number increases at an increasing rate, right? as this goes on. And so the percentage hit will get bigger and bigger and could be the thing that tips us off into a recession. This normally never happens. We all worry about it. They get together, et cetera. There's tremendous pressure on the Democrats. They're doing this basically because of Medicare, healthcare type stuff. And they want to keep the fraud in the system because that's what the Republicans are trying to get rid of. And but their messaging is, hey, you know, they're cutting back and they're hurting people, and they think that's going to get them some points, anti-Trump and cause a recession and then blame him for the economy, which is really kind of playing with dynamite. I just don't understand the thought there, but it doesn't matter what side you're on. It's stupid, and they need to find other things to fight about. So my guess is they'll come back to the table and get this. There's more pressure on them than there are the Republicans, but we shall see. You know, it's sort of like the stock market, right? It can remain wrong longer than you can remain solvent. And I sort of feel the same way with the Democrats. They can be wrong longer than we can remain solvent.
Yeah, good
By the way,
point.
you really soft shoed that a little bit, you know, light touch to it. No, I couldn't agree more, man. That was perfect.
So just in the last 60 days, you've had a lot of announced corporate layoffs, and even Chairman Powell had some mention of that that's something they're watching pretty closely. And again, this kind of points back to, you know, watching for weakness in the consumer and how and back to Dory's point, you know, you've got a lot of furloughed employees, government employees now, and also on some of the unemployment data. If I'm not mistaken, I'm going to kind of go off script and opine here for a minute, but I think under the Doge guidance, those were all basically furloughed through, I think it was the end of September, right? So they're not going to show up on unemployment data because they're still getting paid. They're just on leave. So once that ended, and of course now we're not getting any, you know, government data, but I think that could see some of the numbers as well. Okay, so let's take I love this part here. I really wanted to emphasize a historical look at delinquencies here. Now, this is perfect. If you look at loan delinquencies, one of the things I hear all the time is comparisons back to pre-pandemic. And so if you look at Q4 2019, right there at 1.42% loan delinquencies, and now that's 30 days plus, right? That's everything. That's at a 40-year low. So always keep in mind what you're baselining against if you're comparing back to pre-pandemic, especially fourth quarter of 2019. Okay. And so I really wanted to bring that up because the 1.52 number that Fred is pumping out is, you know, through the second quarter, that's you know, we're doing pretty good. Now that doesn't sell commercials on TV, but those are the facts.
Yeah, can I comment on this for a little bit?
Absolutely.
Yeah, go back. So, you know, this is a really good slide, and it tells you a lot. If you look going into the pandemic, you know, there's a slight, you know, it starts to uptick, but it's more of a reactionary thing, right? It's not going to be a real good forecasting tool, but the market likes to use it as a forecasting tool. We see bad loans, you know, with First Brands and Tricolor or whatever. Oh my God, it's the end of the world. Da 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 da. No, the end starts faster than that. It's something that triggers all of that, and all of those triggers were COVID and 500 basis point rate shock, and it hadn't really happened yet. And there's several reasons for that. One, the underwriting is much better than it used to be in 08. It's the best underwriting that we've had in history. They've done a really good job. Second is banks have staying power because they hold a whole lot more capital than they used to. It's very common for banks to be running 4%, 4.5%, 5%, 6% tangible equity at their holding companies. And I look at tangible equity, those numbers are much higher now, closer to 8% and whatnot. I'd like to see the money centers running at those numbers to make it more safe for the whole system, but they're all over 7 now. In March of 23 for the 12 22 numbers, all of them were running 6% or below. And all the banks that failed in March of 23 were at below 6 and 5% range. So you don't have any room for error. We have room for error. The underwriting's better. And the market still penalizes the public bank stocks because they are afraid that they've got loan problems and they're weak and they're all going to start failing. And we're just not seeing that. We're not seeing that at all. The industry is very strong.
Yeah, I couldn't agree more. Yeah.
Dory,
And we'll,
Dory,
yeah,
it
go
would
ahead,
be safe to say that we don't always learn from history, but is it possible, or is it overstatement to think that we learned a lot in the Great Recession and the aftermath and took appropriate steps to ensure that we were better from an underwriting standpoint and that we were capitalizing at higher levels? How much do you think that's a reflection of what we learned and how we, turn that to our benefit?
Yeah, that's a great question. There are two industries where it's really dangerous to say something. That'd be, over in Midland and the Permian Basin and in banking. And that is, this time it's different. We don't ever want to say that, right? We just do not want to say that. But having said that, there is some learning going on, right? And if we look at throughout history without going too much on it, everything kind of cycles based off of the human error of learning and forgetting. Right? So you start with 1797 and you have a nice big panic there. And then every 20 years we have these panics and they get really bad. We rename them depression. The one in the 1880s, it was called the Great Depression. And then the one we had in the 30s was so bad, we took that name away from them and then gave them a panic and said, this one was a Great Depression. So it's always bad when you're in it, right? So anyway, every 20 years you have these. And my theory is that's because we forget. And then every 5 to 7 years you have this recession. And that's because you have some kind of memory and the credit underwriting's a little bit better. But for the first 100 years of the country, a little bit more, we didn't have a central bank. So it was very, very difficult. We'd have these wild swings compared to London and some of these other markets. We get a central bank. It starts getting smoother in the 30s. We go, wow, we need the best legislation in history to come out and smooth economic cycles, which was, the FDIC and insurance. And that put a lot of stability into it. And then you talk about memory. Those of us in Texas have a memory. I still have scars on my back from the abuse we got in the late 80s and early 90s. We remember, most banks remember. And so Texas banks always traded at a discount to banks nationwide until when? The Great Recession. And then the Great Recession comes along. All of a sudden, Texas banks are trading at a premium because they're failing at a lower rate with less credit problems than the rest of the country. And that's because Texans had a memory. So my fear is the Texans get overconfident and then going forward, we have a failure rate higher than others. But I don't see it right now. I do think people have learned and they do a lot better on the underwriting. You look at construction lending, even as recent as 15 years ago in the Great Recession, they were doing 90% loans on estimated fair value, after complete. No one does that. No one does any of that anymore. Not even in private credit. So there may be a few outliers, but that's not standard underwriting. And I think there's a good, I could have answered your question and just said yes, but I thought I'd ramble for a while.
That was
No,
pretty
no,
good.
no, I like
great.
that better. Yeah.
Yeah, that historical context. And I'm glad you brought up there was a great concern recently about commercial real estate and those banks that were heavily concentrated in urban areas in multifamily and non-owner occupied properties. But that really has not spilled out into the broader banking community. And I think that's another reason why we're not seeing, more evidence of any problems credit-wise in terms of credit quality. And you make such an excellent point there about underwriting standards. I think those have strengthened, and not only that, but the ability to apply them more effectively based on tools that are available today. So all of that, I think, has played a central role. Okay, Sean, let's move on at the risk of spending too much time there.
Yeah. Now, and if we drill down into these delinquencies on some of this Fred data and take a look at consumer loan delinquencies, you see a little bit of a different pattern here post COVID, right? We're still, if you look historically, we're still doing really good. There was a sharp increase after 2000, or I'm sorry, after right around 2022, and the trajectory is a little bit alarming, but we have seemed to level off a little bit for the first 2 quarters of 2025. But again, historically speaking, we're in really good shape. Now we'll jump forward with a little bit. We'll dig down into this number. And what I did is I looked at the Fred data on credit cards. And really, if you kind of flip back to that last slide and forward again, these charts almost mirror themselves. And so you can see that the credit card delinquencies are really driving the consumer delinquency side. But again, we're doing really good. If you go back I go back to the early 90s, I mean, we're doing really well. And it looks like we have leveled off the first 2 quarters of 2025 and actually decreased a little bit. Now, some of this is due to a higher rate structure. Some of these balances starting to carry out a little bit, but the rate structure is a big one as well.
Just a quick comment on this. I am a little bit worried just because of this uptick about the consumer. The consumer drives not only the U.S. consumer drives not only our economy, but the world economy. And so the strength of the U.S. consumer is paramount. He or she is proving to be extremely resilient, which is pretty amazing. I'm surprised these aren't up even more, to be honest with you, given the relationship, as you hinted, about wages, the slow growth in wages, the massive inflation we have in housing, and cars and other areas. So I do think the consumer's pretty stretched. It needs some relief. That's why you see the president pushing, rightly or wrongly, on the Fed to lower rates. And I do think it would help the consumer. It just sort of, is a hidden tax on elderly and others for savings.
Yeah. Now, I always like to bring this up because, and again, we talked about CRE a little bit. We're gonna talk some more about NDFIs here in a little bit because that drove me crazy. But I want to bring this up on credit cards. If you remember, I think it was about a year or so ago. Media outlets absolutely lost their minds when total credit card debt exceeded $1 trillion. That was all you heard for 3 months on media outlets. And nobody adjusted that for inflation. So if you take a look at this right side graph, and when you adjust for inflation, we're still 13% below the all-time record, which was 2007, 2008. So, not saying that, that doesn't bear watching, because it does, but oftentimes you got to look, you can't really compare these on nominal dollars. You got to do an inflationary adjusted look back. Okay, so now we're going to get into some cool stuff, some things that Dory loves. So some bank performance, yield curve, and this I thought was kind of cool. It's a lot going on here. I'm not going to spend a lot of time, but we have had a series of FOMC rate cuts. And I did try to kind of map out the yield curves. You can see the bottom couple here are more recent. I did drop in the closing prices from 10/29 last night and actually this morning. And you can see that, the rates are having an impact on the short end of the curve and somewhat towards the middle. But when you get to the 10-year and out, you've still got compression there. We finally have a nice yield curve from 2-year out, but we're still inverted on the short end. And then you've got compression on those rates at 10 years plus.
Okay, I got a question for Mr. Dory here. When we get I don't know what the opposite of tightening is, since it's not easing, obviously. But whatever we're going to call the end of QT, how much is that going to affect this on the, let's just say what normal people would look at this and think, gosh, the 10-year should drop if they drop rates, and then you see it kind of go sideways. How much is that going to be a factor?
Well, the 10-year is a real magic, right? Because the Fed can't control the long end; it really controls the short end. It can influence the long end, but it was buying securities, right? So we got what 6.6 trillion on the Fed balance sheet, and they really haven't been selling much. So I'm not sure we have an accurate reading on the 10-year. I'd like to see them sell those securities, but they don't want that rate to go up. In fact, what doesn't get a lot of press is Trump is pushing them to buy some more securities, get that 10-year down, so that
longer end
mortgage down. And I think that's a false reading. My big fear, this is where I was wrong, or at least I was worried about it. If you remember a year ago in September, the Fed cut 50 basis points, Mickey Bowman dissented, and then the 10-year went up 50. And so I thought when they started easing or cutting this fall, we might have the same thing happen. That has not happened. You can see there it's dropped down to 4 and it's dipped down below it at times, which is extremely positive for Trump, the Fed, and every. But I'm not sure the reasons why. If they haven't been buying securities, why is that coming down? That doesn't make a lot of sense to me. Maybe it's just an increased confidence in the U.S., which is good because a lot of countries have been selling the 10-year.
Point. All right, kick us forward, Rick. This is kind of ugly. I wanted some different colors in here, but basically just wanted to look at a 5-year chart of KBW Bank Index. You really kind of have to squint your eyes a little bit. You can see the drop off in the 2023 bank runs, and this is in conjunction with S&P, which is also maybe not the best baseline because of so much tech load here recently and AI lift. And then you can see April 2025, Liberation Day, the tariff announcements, kind of what happened there. And if you look at the right-hand side, this is regional banking ETF, and that's since April, since our Liberation Day. And wow, what a difference! That's a lot of performance. And again, that's compared to the S&P, which is that thing has gone nuts because of a lot of the tech and the AI lift that we've seen. So the banks have responded and rebounded well. I think Dory, I would love to hear your thought process or your thoughts on how bank equities are performing these days.
Yeah, we used to have a hedge fund. I wish I still did, so I'm just doing it myself. But I will tell you, it's been pretty easy to trade. Let's call it a bank index for a number of years. Okay, and it's become very predictable. Anything that is a fear trade, you look at the fundamentals, and banks sell off because of fear, because of bank runs, because of Liberation Day. Something bad goes wrong. There's a flood in Bangladesh, and a community bank in Austin sells off. But those are all buys. Those are all buys, and that's been happening ever since 08, and it's been the easiest thing in the world to do. So I will do that with big banks or small banks a lot of times. And you can see there on Liberation Day, it sold off way more than the S&P, right? Great buy, with maybe the exception of NVIDIA. I was able to buy a bunch at 90. And that worked out pretty good. Now, what's still frustrating to me, but it still creates good investment opportunities, is I still think banks are very undervalued compared to the rest of the market. The market doesn't understand those two key components of underwriting, credit performance, and the second one being capital levels.
Capital.
And
capital.
And then we have some built-in. When I invest in a bank, I'm with our private equity fund or something, I'll tell them, hey, here's one key metric. It's kind of like I learned that from Buffett. He'll write them a letter and say, here's what I want you to do, real simple. Well, I'll do that with banks and say, grow your tangible book value per share at 8 to 10% a year, but not at the expense of credit. And that's really all you got to tell them. It's all encompassing. So what that also tells you is that's how you buy bank stocks, and you go look at them and find the ones that are growing at that kind of rate. Because if you think about it, if you're in something that's growing 10% tangible book value per share a year, and even you private banks, this is a great metric to manage your bank on, and you're in at book value, and let's say the bank's worth 1.5 book or 2 book later on, you're growing your value at 15 to 20% a year, and so that's a little different metric than ROE, but it's a lot better. It really gives you a full picture. And there's a lot of banks out there doing that. And we have this hidden benefit that's showing up in there that's growing this tangible book value faster. And that is the AOCI issue, banks with these embedded losses. It's adding to, as those kind of run off, or the duration of those securities gets shorter, that tangible book value per gross share increases at an increasing rate than it normally would. That's extra value that you're getting. You just have to make sure the bank has plenty of tangible capital to withstand that.
Yeah, and I'm actually really glad you brought that up, because that's another thing that Rick and I have been talking about for a while, is that we've been expecting some of those AOCI losses to really start decreasing, primarily because we saw the influx in cash at 2020, right? Banks
Right.
had to go a little bit longer out on the yield curve to get any kind of a return. And so from a duration standpoint, you should be seeing a lot of that cycling off at this point. Plus, you've got rates starting to come down, but
Well,
it's a little bit of a
way. For 50 years, I did a lot of portfolio asset liability management for hundreds of banks. For 20 years, we had a nice business in that, and I taught AL to numerous banks, and the average duration on a bank bond portfolio should average for 50 years was 2 years. Well, during the post 2008 area, somebody thought it was a good idea to stretch that to 6 years with less liquidity, with higher loan to deposit ratios, right? And I never could get comfortable with that. So think of it this way: if the average bank was running 6 years, and we're 2 years away from the 500 basis points, that's how much you're running off a year on average.
Yeah.
So you're saying we have an answer to what could go wrong?
Yeah, what could go wrong?
So
Sean,
this kind
let's
of
move
points,
on to M&A if you would. Yeah.
Yeah, and it's just real quick on this. I didn't want to go back and do a big historical perspective, but really a combination of those securities portfolios repricing, the bank equity stocks out there. We've had a resurgence of M&A this year, particularly from the third quarter. We had 59 announced deals in the third quarter of this year, which was stout by any measure. Banks are performing well. You got an increasing net income, lower cost of funds, more favorable yields as some of these assets roll out. And really, I think the punchline is down here. If you kind of annualize this, we've got 143 year to date, and say it's 170 or so. That really brings us back to pre-pandemic industry consolidation rates of around 3 or 4%. Pretty much what we've seen historically. You want any comments on that, Dory?
Yeah, so a couple of comments. One, I want to go back to what Rick said earlier about memory. For some reason, banks have a credit memory. They have no memory about asset liability management and investing long-term in their portfolio. I don't understand it. It doesn't make any sense to me why people are buying 1%, 2%, 10 years or whatnot. And I thought we learned that lesson already. So why people get an F for that, I don't understand it at all, and with anyone. And I've been pretty rough on my clients that have made that mistake. But there's no reason to make that mistake. That means that's just arrogance, and you need to ask for help instead of thinking you know everything. Hey, you're absolutely right, and it's even faster paced than you think. If we take 60 and multiply it by 4, that's 240. We don't have that many banks out there, so the percentage of banks that this is happening on is a really fast pace. Yeah, I've got a projected 175 for year end. Who knows? I know this: we're busier than we've ever been. And here's the crazy thing: it's not a frenzy. It is not a frenzy at all. The buyers are as disciplined as they've ever been. The tangible book value earn back per share used to be over 5. Then it was 5 for many years. Then it moved to 4. Then it moved to 3. And a lot of these deals are getting done at 1 to 2. The multiples that these banks trade at are, say, in the book and a half or so range. And so that's what they're buying banks at. They're not paying 2 and 3 book for them. The preponderance of deals are in the 1 to 1.25 range. Okay. But the sellers are realizing, hey, I'm not just getting bought, I'm buying the acquirer's stock. His stock is a good value. He's got good tangible book value per share growth. His credit underwriting's good. I'm going to get a pop, and he's undervalued. And so when he goes up $1, I'm going up 1.25 or 1.5 because he gave me a multiple. I can get there faster. And then guess what? He's going to get bought within 5 years. I can get there faster than I can get there myself. And that's sort of the overriding theme of what's going on.
Great insight there.
Yep.
You know, one of the things we're frequently asked is, you know, how to predict who the acquisition, the most likely acquisition targets. Well, it's easy to do that on the acquisition side because, among other things, you can look at their historic appetite for acquisition, but a little bit harder on the other side of the equation. So maybe not today. I don't know that we really have time, but I'd be very interested in your thoughts, you know, about how you go about identifying who you believe to be, you know, target opportunities for banks that are looking to acquire. So, Sean, in the interest of time, go ahead. No. Go ahead, Dory.
Well, a lot of it's coming from the acquisition side. So, you know, I get a call from Huntington. I didn't go to them. And they said, we need to be in Texas. We haven't bought a bank in a while. And after 2 years of analysis, you know, it's Veritex. Now, I told them on day one the analysis is going to go to Veritex, but it took 2 years to prove it up to them. So we're getting a lot of that. So these big regionals that have been out of the game because the regulators have said, you know, made it uncertain. Now the green light is on and we can buy not only 1, but maybe 2 banks a year. So that's pretty interesting. The risk is these smaller banks, what they don't realize is if I were selling a bank in Dallas, used to I had 20 buyers, right? Now I may have 1 or 2, even though I've got less than 25% of the supply of community banks to sell than I did 20 years ago. There's fewer buyers, there's fewer sellers, and they're more disciplined. So you sort of have to be thinking about this. And these banks that are so reactionary, they're like, oh, somebody called on me, told me I'm a pretty girl, so I love them. Or, you know, a Wolverine makes a good house pet, so I think I'll buy one. Yeah. You know, it's a terrible way to run a business plan and exit when they really ought to be putting some thought into it that is not just 6 months, but maybe a year or 2 in advance. But particularly if you're out in West Texas or some of these other markets, the buyers that are buying today are not going to be there tomorrow. And your audience of purchaser is getting very, very slim. And this old way of thinking that, well, I'm always worth 1.5, I'm always worth 2 books. Yeah. No, it just depends. And here's the terrible thing about it. There may only be 1 buyer for you, and it may be Satan. You may not be able to get along with them. You know, if you want something that's a culture fit and this, that, and the other, you got to put some time and effort and forethought into it. And I see less of that now than I ever did.
Awesome.
Interesting. One last question on M&A. I'm sure you must be asked this question from time to time, but if you project ahead 5-10 years, we're roughly somewhere between 44 and 4,500 banks today, down significantly, obviously, from where we've been in prior years. What does your crystal ball say in terms of where we might be 5 to 10 years out?
Well, you got to pick one, 5 or 10, right?
Yeah.
Well, we can talk about both of them. One way is to kind of look at where we are now, because I think it's a shock. You know, I'm living in the past a little bit. I remember when there was 19,000 banks in the country in 1980. Then we went to 12,000 in 1990. And now we got this small number now. And, you know, and Texas always had 1,500 banks, then 1,000, 600, now 300. I looked at a deal yesterday that showed that we had 82 banks below 250 million in Texas. So, wow, they're all different. We don't have any de novos. And so one thing, working with Chairman French Hill on the Financial Services Committee, he's the first banker we've had heading up that committee in 100 years. And a number of years ago, he called me from Little Rock and said, "Hey, I want you to sell my bank." I'm like, "Why do you want to sell?" He goes, "I want to run for Congress." And I thought, have you lost your mind? But we're real lucky to have him there. And one of the initiatives is we got to figure out how to ease the de novo rules so that we can do de novos without it being a pendulum issue of making it too easy and too risky for the system. We have to make banks investable again. The capital's not there. We don't have our hedge fund anymore. My bank, private equity bank fund does fine, but you know what? Not to be bragging, but we're one of the best in the business and have one of the best track records. And compared to investing in most anything else, where people are getting 20 and 30 and 40% returns, we can't do that in our business. We get nice, smooth, mid-teens IRRs and 2x on our private equity funds, but we're boring, and most of the bank-specific institutional investors have disappeared in the market. So what does the industry look like? We're losing capital, and we're also losing banks because they're disappearing, and we're losing de novos, and it's being disintermediated into private credit, and private credit's unregulated and it's picking it up. Doesn't mean it's more risky, but it's potentially more risky, and it's tougher on the banks. And we lose our identity. This is a big swing at the bat here, but it's a big deal. We lose our identity as Americans. What do you mean by that? We're the only country in the world with a community banking system. And these small banks provide 70% of the loans to small businesses, which provide 80% of the new jobs. You want to know why we have the most robust economy in the world? You can point to one of the biggest reasons, which is community banks. And I really worry about that.
I think that was the most precious words I've heard in a long time. I mean, man, that was great. And the other thing that really needs to go hand in hand with this is, and I know you remember all this, there was a time where it wasn't uncommon to lose. I'm talking failures, I don't know, 50 a year, but we're creating 60 a year. It wasn't, it's really more like 120. But I mean, point being, we haven't been losing banks to failure. Now there was, an SVB here, or, almost every one of these has got a 3-hour debate of cause and effect, but it's not necessarily bad loans here, right? Which has been the traditional, bane of the existence of community bank or anybody else in a failure would be bad loans. Okay. We're not doing that. This is literally self-emulation for $1. I can't figure out how to make money, so I'm going to sell my bank. That at increasing numbers that are just literally extinction level events. It's staggering to see Travis Hill get in there and say, you know what, we need to have more de novos. I couldn't agree more, but you're going to have to change the structure so that, it is more investable. It is something that people can say, if we were to fail, it's not the end of the world. But at the same time, allow them to go where the money is at. You're pointing out the growth, and, we loosely use the word private credit here to encompass 4 or 5 different things, but that massive movement of money, and that is all going through the fintech sector for the most part, and then being sold back to the larger 31 institutions. And so what we run into is this really weird dichotomy of the smaller banks are not participating. They're not participating on the purchasing side of that either. So they're kind of just like dwindling on the vine and missing the party. And then you look at a SoFi or somebody else out there that's completely changed the world. These guys, you talk about a crazy run bank, they're over here selling off to those markets. So it's a real interesting time, but a lot of opportunity out there for I just call it the new era of banking, which is a technology driven perspective instead of the same old. But the losses, they're not from failure. They're just from people selling.
Yeah, you hit some great things. We hate to say it, but how do we put risk in the system so that we draw better returns? Because it's so let's call it discipline risk. Maybe that works. How do we introduce some discipline measured risk in the system? And then your other point, indirect point, I think you were making is we already have this private credit risk through those 31 institutions or whatever. It's indirect. They lend to them, lender finance, and yet it's unregulated. And so you're totally trusting the underwriting of the banking industry, and hopefully they're doing a good job with the lender finance vehicles that they're doing. But we know there's some crazy stuff out there in private credit. We're still, as someone brought up earlier, the commercial real estate. Where is it? Is it in structured finance? Is it in CDOs, CLOs, lender finance? It's out there somewhere because the big banks say they don't have it, and the small banks say they don't have it. But it showed up in Tricolor and First Brands, and Amy Dimon said, "Well, we have some cockroaches. Maybe there's some more out there." And so now everyone's looking under their bed. But I'm really not seeing it in the community bank sector.
I agree completely. And on that same topic right there, where it's really hard for everybody to stand back and say, look, okay, we've made a measurement of this on the 31 call report and pulled this information out and segregate, which obviously knocked down CNI and CRE. But to the extent that it did, I think shocked the hell out of me. I'll just say the volume. And this is one of those things the last 2 years, I've been like, I can't believe how many times my jaw is on the ground over the amount of the dollars involved in this particular sector. And okay, cool. We've now peeled it off to where it's almost a memo item identifiable, but we have no tracking on the non-performing side of that gives any guidance or clarity. Am I missing something there?
Yeah.
Is there anything that we ought to be looking at?
Oh, I'm sorry. No, I mean, I think you hit the nail on the head. And I think most people are still, I mean, everyone's worried, we're all still running from office space, right? I mean, it's not like we can have a deal show up here at Commerce Street with office and we're going to go place a bunch of loans and raise a bunch of equity for it. That's not going to happen. Our guys are turning those down cold, no matter what it looks like. Well, I got this great place on the toll road up in Frisco. Surely we can. No, not interested.
I'm going to have to call time on what has been, I think, a very interesting discussion and admit what's probably obvious to our viewers right now, and that is that we've done a very poor job of time management today. So the part of our presentation that was intended to address the banking sector, we're really not going to have time to go through that.
We can hit a couple of highlights.
Cool. Banks are looking good. Bank stocks should be going up. We don't have a non-performing problem. Sky is not falling, but we are concerned about the amount of M&A, but we expect it to increase. Is that pretty decent?
Pretty much.
Yeah. Let me just go through. If everybody can see my screen, I'll just go through a few things here real quickly. Well, one thing I do want to mention, that this is something that's always of interest to me. How easily we talk about million, billion, and trillion as if they're first cousins. And really, when you think about it, you start talking about the vast differences. Every time I look at this, it's stunning just, how much difference there is between a billion and a trillion. The national debt, that's a whole nother subject for another day. But I do think it's interesting. You see the interest on national debt now approaching $1 trillion. So at some point, there's a lot of concern about what the longer term implications of that will actually be. Can you see my screen okay?
Yes.
Okay. Asset growth over the last 4 quarters Nothing to write home about, but a little bit of an uptick in the September quarter. Percentage change in securities, you see some growth in the securities portfolio. You take a look at deposit growth, a big improvement there in terms of deposit growth. We take a look at loan growth, a little bit of a decline there. But as you can see from all of those growth numbers, no significant, what I would consider to be significant growth going on in that respect.
And Rick, do you have anything on cost of funds?
Yep.
Oh, yeah. Yeah. Let me get down to that. It actually ticked up by 1 basis point, but you can see that the trend has generally been declining. But when you look at some of the other, let me get back to, if you look at yield on securities, look at yield on earning assets overall, you can see the growth there from over the last number of quarters. Let me get to loan yield. Yeah, loan yield, same thing. So on all of the earning assets in the bank, we're seeing improvement, and that improvement has been significant enough to improve net interest income for banks. And the cost of funds remaining steady. To be honest, I was a little surprised. Sean and I talked about this, and I thought cost of funds would actually decline a little bit in the quarter.
Yeah, keep in mind this is a pretty limited control group. We've got about 70% of community banks that have filed, so
Yeah.
we've got a limited picture. But most of the time, this is almost always directionally accurate.
Yeah. I don't think there'll be any big change in these numbers. And to be honest, if you look at the wanted to take a look at the efficiency ratio, you can see in orange the expense levels over the last number of quarters. In blue, you can see the elevation in overall revenue.
Okay.
And as a result, you see the improvement in efficiency ratio. And also, if you look at return on assets for this group, you see a nice uptick there. And it'll be interesting to see how that goes for the rest of the year, especially in view of the fact that, we're going to have the rate cut, though I don't think that will, Dory, you can weigh in on this if you like, but my hope would be that if we do, in fact, see more movement in cost of funds, downward movement, that we will actually see a continuing improvement in return on assets through the remainder of the year. The other thing I wanted to point out is, even though we've seen an uptick in non-accruals and charge-offs, look at the loan loss reserve, the loan loss allowance over the last number of quarters.
Yeah, it just doesn't get much flatter than that.
No. So, I mean, typically, if there were grave concerns about the future, if there were concerns on the part of individual banks about the adequacy of their allowance, you'd see growth, I think, there, and we're just not seeing that. So I would say, just from what we've seen so far, it's a benign quarter, generally more positive. And as long as the credit quality holds up, and for the reasons you cited earlier, and I'm going to stop sharing so we can talk among ourselves.
Can I ask Dory a question?
Yeah, go ahead.
Do we have time?
Yeah,
we've got about 5 minutes, I think.
Okay.
4 minutes.
So first off, I think I'm with you on this, buy the dip. Every time you see these indexes drop down, on the regional, super regionals, just buy the hell out of these things. There's no reason to run from this. My big question, I'm pretty certain that if we continue to have a lowering rate environment, maybe one more at the end of the year and maybe, a couple next year, does this fire up the mortgage engine again, where if that, I've always just kind of felt like we took the little freeze gun and just froze the whole mortgage market, which is kind of the heart and soul of a lot of banking. And if we can get that engine moving again, just a lot of income to be generated. I've got friends of mine in their 60s, and then I've got friends in their 20s, and neither one of them are wanting to buy or sell. And so it seems like this thing kind of loosens up a little bit, the commerce from that. But the threat is, boy, if we went the wrong way and we have to raise rates back to the private credit and the other issues, this could be just a snowball from hell. Am I seeing this thing right?
Yeah, absolutely. And you're reading from Trump's playbook. He wants to get that mortgage rate down so that we can revitalize jumpstart. It's an easy way to get a kickstart, right? Now, here's the problem. How much do you have to get it down? If you think about where rates were, before 2020 or before the 500 basis point rate shock.
Doesn't work that way,
Historically
buddy.
low.
You're not getting away with that shit.
Yeah.
So you got to tell us where those numbers
Rates are not, the 10-year's not going to 1.5. That ain't going to happen. It's not going to 2. It's not going to 2.5. Can we get it to 3.5? Maybe. How much do we have to cut rates to get it down there? Again, the cuts we've just had are very promising because the 10-year has come down, which means, Dory's fears are not materialized. But that's what I worry about, is that the curve just gets steeper and steeper the more they cut, and it just stays up there. And I don't think they're going to have the justification to just keep cutting and cutting. Even in December, right? We heard his words. It's just not a given, right? And I've been saying that all along. It's not a foregone conclusion. They're running data blind now. At some point, that's going to matter, and you don't want to risk inflation over that. But it would be nice, but you hit the nail on the head. We don't want to do that. And back on those cost of funds issues, that tells you something, that they're flat and not going down. What does that mean? That means they're having to pay up to keep those deposits. The fight for the depositors is still very real.
Okay. One last question, Dory. What's your greatest source of optimism going forward and your greatest concern going forward?
Well, my greatest, there's two things right there. One is I'm a Christian and American exceptionalism, so I believe in that. And I am also optimistic. I tell a lot of my speeches that virtue wins the day, right? And we're seeing a lot of issues up in D.C. That there's a big war going on, really basically about morals and virtues. And they've always had that problem, but it seems to be at a bigger extreme. But, one of the great things about all the bankers and people I deal with is 90% of them are virtuous and moral. They participate in their community. They don't cheat the customer doesn't cheat them. We treat our family right. And as long as we're all doing that, then, we're going to win the day in that. I'm optimistic about banking because it's such an important thing. And it's about as strong as it's ever been. We just need more of them. And we need maybe even introduce some, as what Dave was talking about, a little bit of disciplined risk into the system so we can get more capital to it, and embrace new technology, which the administration wants to do, and fintech and things like that, but on a disciplined basis. I'm very optimistic about going forward. As much as all the bad news and the media and DC want to fill us with, that doesn't mean everything is bleak.
I'll tell you what, Dory, you're just a badass, been a badass your whole life. I wouldn't want to fight you. I think you're all right, man. You really are.
Well, I'm 6'4", about 265 pounds, but I'm old and everything's breaking, so I'll probably be pretty easy to whip.
Okay. Okay.
Well, thank you for your time today, Dory.
Yeah.
Very, very helpful and informative. And again, apologies to our audience that maybe we didn't get to some of the stuff we wanted to talk in greater detail about. But when you have somebody like Dory on, you got to pick the guy's brain.
Gotta let it. Yeah.
Right.
Yeah. And we'll distribute slides to whoever needs them.
Well,
thank you, Dory.
Thank you for having me on. Wonderful group, wonderful discussion. I enjoyed it immensely.
Yes,
Thank
sir.
you. Take care,
Have a
buddy.
great day.
Bye-bye.